Last week, Ray Dalio and Larry Summers sat down for an interview for the Qatar Economic Forum, and within that 30-minute session, Dalio rehashed a lot of his theory about inflation, interest rates, and where the stock market is heading over the next decade or so. But he also explained in further detail what this new paradigm that he's always talking about may look like, and what investors need to know who are entering the markets in 2021. So that's exactly what we're going to get into in today's video, and if you do get some value out of today's video, I would very much appreciate it. Take the 2 seconds to leave a like on the video and hit that subscribe button if you want to stay up to date with more content in the future. But with that said, let's jump into the video. Also, starting to date, my private investor community, Learn by Example, is now taking new members until the end of July. You'll be joining a private community of 300 value investors, get access to over 100 hours of exclusive content, including weekly live streams, example stock analysis, and a valuation crash course. Plus, I'm available to you on a near daily basis to answer your investing related questions. So if that sounds like something that you would be interested in, check out the information page linked down in the description below. And at the moment, until the end of July, you can get 30% off if you join. So make sure you check that out if you're interested. But with that said, let's jump into the first clip.
We're looking at a current rate of inflation that, if you look at the last 2 or 3 months, is running close to 8%. Now, no one thinks that that's the new built-in rate of inflation. So, of course, there's transient inflation. The important question is whether that is 6 percentage points of transient inflation or 4 percentage points of transient inflation. And I don't see the basis for policymakers' serenity that it's only that it's a full 6% of transient inflation. I welcomed the Fed's limited efforts to mark its views towards reality and a growing awareness that this overheating is likely to necessitate a monetary policy response. But I still think the reality of overheating, just if you look at the most basic numbers, is being overestimated. The prevailing forecast at the Fed, in the White House, indeed in much of the consensus of professional economic forecasters in February, was that we would have inflation just above 2% this year. We've already had more inflation than that in the first 5 months of the year. That would suggest to me that people should not just modify their forecasts, but should think about what their errors of thinking were that led them to be so far off in their forecasts.
If you're taking a look at inflation over the past 2 or 3 months, and then you annualize that and say if we were to experience that over the remainder of the year, we're currently looking at an annualized inflation rate of about 8%, which is extremely high. On top of that, inflation expectations going into 2021 were just 2% for the entire year. And 6 months into the year, the US has already experienced inflation in the first 6 months of the year of 3.7%. And the main point that Summers is making in this clip is not necessarily that 8% inflation is going to go on forever. I think everyone can agree that at least a certain percentage of that is going to be transitory, that will go away after 2021. But the point that he's making while listing these statistics is that whatever measures the Federal Reserve is currently using to estimate inflation in the future do not work. And we know this because they estimated that inflation would be 2% for 2021, and we have already almost doubled that in the first half of the year. So what that means is that maybe it's just not possible to project inflation when we have these unprecedented economic conditions like we've seen during the pandemic and flowing into 2021. Or it could simply mean that the method that people are using right now to project inflation is flawed in some way. But regardless of what is the reasoning why expectations have been wrong, what you should know and what you should be confident in is that you should not listen to what the Fed says about their inflation expectations, because them and everybody else who have been making predictions about inflation have been dead wrong. The Federal Reserve has also been going on about this idea of transitory inflation, and that, for those who are not aware, is the fact that during 2021 there have been kind of two impacts that have happened. One is there's been supply constraints, and the other is that there's been a temporary surge in demand. And both of these things create supply-demand inflation, where there is basically a gap between the supply and the demand, and whether that's coming from supply being artificially low or temporarily low, or demand being temporarily high, there can be inflation that is created from that eventually goes away. If there's a lack of supply, eventually production picks up and that lowers prices back down. And if there is a surge in demand, that raises prices and therefore eventually lowers demand for those products and services. And while that argument does hold water, because we have seen supply constraints in certain industries, such as in construction or computing, we really don't know if the current annualized 8% inflation rate, it has 6% transitory inflation and therefore will go back to the normal 2% rate, or whether there's, say, 4% transitory and the underlying long-term inflation rate is actually at 4%. And the difference between 2 and 4% might not seem all that great, but at 2%, the Federal Reserve's current policy of 0% interest rates and huge monetary stimulus makes a lot of sense. At 4%, now being far above what they initially expected, as well as above the recommended rate of inflation long-term, suddenly the Federal Reserve doing $1.5 trillion of money printing every year, which is what they're currently doing as the current rate, suddenly that and 0% interest rates doesn't really seem to make any sense.
The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt.
Here, Dalio is reiterating his explanation of monetary inflation. And I've spoken about this a few times in other Ray Dalio videos that I've done, so I'll go over this fairly briefly. What Dalio is talking about here is how inflation can be driven from the bond market, and what we call that is monetary inflation. And how that happens is currently the US government is spending a lot of money in the economy. And in order to fund that spending, they're taking on debt. And how they take on debt is they sell government bonds to the general public. And when there is not enough demand in the general public for those bonds, the Federal Reserve steps in, they print a bunch of money, and they buy those government bonds from the government. So the Federal Reserve is essentially filling the demand gap that is occurring because the government is spending a bunch of money and needing to sell a lot of bonds. And because the Federal Reserve wants to keep interest rates at zero, they do that by buying those government bonds. The problem can occur when inflation starts to pick up and you have government bonds that are offering like 1%, and if inflation is 4%, there is zero reason for people outside of the Federal Reserve to hold those government bonds. And what you can see happen is then not only is the US government selling bonds, but people who just own government bonds, the general public, sometimes people from overseas in foreign markets as well, start to sell US government bonds. And that could mean that the Federal Reserve needs to ramp up their printing of money and the buying of those bonds. And as I mentioned, in total, the Federal Reserve is spending $1.5 trillion per year of money that didn't exist before they created it this year on mortgage-backed bonds and government bonds. So a significant portion is going to bonds. I think it's $80 billion a month is going towards bonds. So, that's a significant amount of money every single year, about $1 trillion that is going and being printed and spent on these government bonds. And if they have to ramp that up even further, that's where you can have serious levels of inflation start to pick up. And then what is the flow-on effect of bonds and cash being terrible long-term investments, because bonds are offering no interest rate and cash is also offering no interest rate? Well, people flood into stocks and property, and they are willing to pay anything for those assets because anything is better than nothing. And as a result, you see massive levels of inflation in the financial markets.
And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, like to borrow houses right now, I mean, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. And the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand, monetary inflation, and also the Fed tightening. I think Larry and I agree that this is looking more like the late 60s transitioning to the early 70s. And then I'll also say, though, and that has implications for the balance payments in the dollar. So we've covered that. I'm more worried about the inflation in financial assets and what that means for returns and bubbles that are developing, because there's a massive amount of liquidity around, and it's being thrown around so that it's a difficult environment for those returns to be justified. I think we're building kind of a bubble. So I think inflation in financial assets and so on is an issue related to liquidity.
Dalio in this clip is raising concerns about inflation in financial assets. In a video I covered last week, Dalio did an analysis of whether stocks are in a bubble or not. And for those who didn't see that video, essentially he reached the conclusion that specifically in emerging technology companies, so new tech companies that have been born over the past 10 or 20 years, there is a significant level of bubble activity going on, very, very high valuations, lots of people speculating on prices, but that broadly speaking, things didn't look like a bubble yet, but were trending in that direction and had been over the past decade. And while all of this money flowing towards stocks and property has been great if you've been investing over the past few years, and pretty much you could have invested in anything and probably have made money, even though that's the case, the irony is that all of this stock market appreciation, all of these expanding multiples is terrible for anybody who wants to invest or is planning on investing over the next few decades. Because prices that are high and getting higher relative to current earnings, all that means is that future returns are getting worse and worse. So the higher that stock prices go now, the worse long-term future returns are looking. And the truth of the matter is, if you are investing over the very long term, what you want is prices to come down relative to earnings of businesses so that long-term returns go up. And that gives you the opportunity to invest in businesses while they're cheap. And of course, if you're investing in really good businesses while they're cheap, you're going to make significant returns over the long term. Ray Dalio and many other investors have been warning about low returns in the financial markets for many years. And I think because they've been talking about it for so many years now, some people are kind of looking at that and thinking, look, Ray Dalio was wrong. So it really doesn't matter what price we pay for stocks, and we should expect stock prices to continue to go up at a massive rate. But the truth is that because stocks have continued to go up at a huge rate over many, many years, it just reaffirms that we should be seriously concerned about what is going to happen in the future. And also, nobody knows the timing that these things are going to happen. Nobody knows when the stock market is going to crash, which is why why it's always a terrible idea to try and time the market and get out of the market completely and jump back in after a crash has occurred. That has always been a terrible strategy, but we should appreciate that when valuations get this high, and when you're buying either individual businesses at high valuations or buying an index fund at high valuations, you should expect low long-term returns. That doesn't mean that next year the stock market's going to crash. It doesn't mean that returns are going to be low single digits from this point onward for the next 10 years. Stocks may continue to go up at high double digits for the next few years. Who knows what is going to happen in the short term, but over the very long term, business returns revert to the profits that businesses produce. And currently prices are seeming to suggest that businesses are going to grow at 10%, 15%, 20% per year into infinity. That is not going to happen. So I can be very confident that if you're buying a lot of stocks today at current valuations, returns are going to be extremely low. But I'd love to hear your thoughts down in the comments section below. And I hope you guys got some value out of today's video. If you did, make sure you leave a like on the video. And if you want to stay up to date with more content in the future, then make sure you hit that subscribe button. We're closing in on 100,000 subscribers, and I would love to hit that by the end of the year. So I would very much appreciate if you take the 2 seconds to leave a like on the video and hit that subscribe button if you want to stay up to date. But with that said, I'll see you guys in the next video.